Today, we're opening up what is basically a premium guide on how to build real generational wealth. And look, I promise you don't need to be a Wall Street insider for this, you don't need to stress over chaotic stock charts all day long, and you absolutely don't need a math degree. We're going to explore exactly how ordinary people quietly build true financial freedom. But first, let me start off by asking you a very real question. Think about it for a second. How much did you spend on food delivery or coffee, late night snacks, or just random online purchases that you really didn't need this month? Now imagine something incredibly powerful. What if you took that exact same small money and invested it every single month instead? I'm not talking about thousands of dollars or some crazy millionaire amount, just small money, consistently. Because honestly, the crazy truth that nobody really tells you is that most people don't stay broke because they earn too little. They stay broke because they never learn how to actually grow their money. So here's our roadmap for today. 1. The automatic investing secret. 2. Mastering dollar cost averaging. 3. Index funds and ETFs. 4. The power of compounding. 5. Avoiding biggest beginner mistakes. And finally, 6. Beating inflation over time. Let's dive right in. Section 1. The automatic investing secret. Growing your money automatically. Okay, so there is a massive fundamental difference between people who trade hours for dollars their entire lives and those who actually figure out how to make their money work for them. And this brings us to SIP, or automatic investing. Basically, it simply means investing a fixed amount of money on a regular basis. You automate the whole process, and then you just let time and compound interest do the heavy lifting for you. Think of it kind of like going to the gym, right? Working out once for 10 hours straight, it literally does nothing. But 30 minutes consistently every single week for years, the physical results are massive. Well, investing works exactly the same way. Small actions repeated for a long time completely change your future. And the crucial reality here is this: starting early and consistently is infinitely more powerful than waiting for the perfect time. Look, most beginners stay stuck in this waiting phase for years. They're waiting for a perfect market or a higher salary or until they just feel completely ready. But here's the secret: perfect conditions rarely exist. Every single year you delay, your money loses valuable time to grow. Waiting might feel safe in the short term, but over decades, it becomes an incredibly expensive mistake. Moving on to Section 2, Mastering Dollar Cost Averaging, removing the emotion from investing. This is all about the behavioral psychology of money. Dollar cost averaging, or DCA, means you invest the exact same amount of money on a regular schedule, no matter what the market is doing. Up, down, sideways, it doesn't matter. You see, the stock market is highly emotional. Beginners tend to panic buy when prices are super high out of FOMO, and then they panic sell during a crash out of pure fear. Dollar cost averaging stops that emotional cycle dead in its tracks. You're not guessing if today is the perfect day to buy. You just stick to the habit. Here is how it actually plays out mathematically. When the market is high, your $100 simply buys fewer shares. But when the market drops, that exact same $100 suddenly buys more shares at much cheaper prices. Over time, automatically buying through those highs and lows smooths your average cost out perfectly. So no perfect timing required at all, just patience and consistency. All right, Section 3, Index funds and ETFs, where the money actually goes. So what are the exact practical toolkits that beginners use to actually execute these automated strategies? Well, a prime example is the S&P 500 Index Fund. Instead of trying to pick one single winning stock, which, let's be real, is incredibly risky, you're buying a tiny piece of around 500 of America's largest companies all at once. Imagine you're carrying all your fragile glass items in one single grocery bag. If that bag drops, everything breaks. But if you spread those glass items across hundreds of different bags, your risk drops dramatically. That's built-in diversification. If one company struggles, your whole investment doesn't just crash. Now, you'll often hear about ETFs and mutual funds. ETFs, or exchange-traded funds, trade like stocks all day. They're highly flexible and typically have very low fees. Mutual funds, on the other hand, are priced just once daily and are often actively managed by professionals, which unfortunately means they can have much higher fees attached to them. This is exactly why legendary investors like Warren Buffett recommend low-cost, passively managed index ETFs for the average person. Those active management fees, they can quietly eat away thousands of dollars from your future wealth without you even noticing. Some really popular beginner options include S&P 500 ETFs like VOO or SPY, which cover broad US large companies. Then you have total market ETFs like VTI for the absolute broadest diversification possible. And finally, NASDAQ ETFs like QQQ, which are heavily focused on technology. But a quick warning here, while tech-heavy ETFs do offer higher potential growth, they also come with brutal emotional volatility during a market downturn. So don't confuse excitement with smart investing. You've got to be prepared for the swings so you don't panic. Section 4. The power of compounding. How time changes everything. Now, this is arguably the most emotional and powerful concept in wealth building. Consider these two different profiles for a second. The early starter begins at age 18, putting in just $100 a month. The waiter starts at age 35. Even if the waiter invests way more than $100 a month to try and catch up, the early starter often still ends up with significantly more wealth. Why? Because compound interest is basically money making money, and then that new money making even more money. It rewards time over absolutely everything else.
There's a famous saying, the best time to start investing was years ago. The second best time is today. Honestly, let that sink in for a second. The most expensive mistake you can possibly make is waiting, because you literally cannot get time back. Even the smallest amount invested today gives your future self an incredible advantage.
Section 5. Avoiding biggest beginner mistakes. Protecting your wealth. Protecting your wealth is often simply about avoiding the bad decisions that destroy it. So here are 4 major pitfalls you absolutely must avoid. First, waiting too long to start. Second, panic selling during normal market crashes. Remember, temporary market drops do not mean permanent failure if you just stay disciplined. Third, chasing risky hype for fast money. Boring consistency usually beats emotional gambling every single time. And fourth, investing without an emergency fund. If life throws you a curveball like a medical bill or a sudden job loss, you never want to be forced to sell your investments at a terrible time just to survive. Build that cash safety net first. It really all comes down to a massive mindset shift. Consumers ask, what can I buy today? They focus on short-term liabilities, things that lose value just to impress other people. Investors, however, ask, what can grow for me tomorrow? Wealthy people focus on acquiring long-term assets that actually put money back into their pockets. Section 6, beating inflation over time, the quiet wealth killer. You must acquire those assets because of the ultimate macro threat we all face, the danger of doing nothing. Years ago, everyday items like food, gas, and coffee were significantly cheaper. Today, that exact same amount of money buys you much less. And in future decades, cash hidden under a mattress will lose massive purchasing power. Inflation quietly acts like an invisible tax. It's constantly and ruthlessly reducing the real value of your uninvested cash over time.
So while having a cash emergency savings account is absolutely vital, keeping all of your wealth in cash means you are technically becoming financially weaker every single year. Holding cash only guarantees you lose value to inflation. Owning assets, on the other hand, gives your money the potential to outpace inflation and actually grow your purchasing power. Start small, stay consistent, think long-term. You absolutely do not need to be rich to start investing. You just need to begin building the right habits today. Real wealth is built quietly through small, smart decisions repeated over years. Your future self will either thank you for starting today or really regret waiting too long. The clock is ticking, and the stock market simply doesn't care about your excuses. It only cares about your consistency. So are you going to be the consumer or the investor?